Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. I want to look ahead to the upcoming US jobs report. This comes at a time when markets are growing increasingly fearful of a resurgence in inflation pressures. And therefore, there's big question marks about whether the US economy essentially is going to keep up its strength and point towards continued pushbacks with regards to the Federal Reserve. In terms of what markets are looking out for, the overview shows that essentially we've been seeing continuous strength in terms of payrolls. 303 last time around, 238 expected. But quite frankly, this decline that's expected each time and the outperformance that happens each time, we've seen it time and time again. Certainly, I'll highlight with that when we're going through things on the sort of payroll side of things. But ultimately, 238 is a strong number either way. So a decline expected, but it's not the kind of decline that's going to push the Federal Reserve into becoming fearful and feeling like they need to desperately start cutting interest rates. Anything above that is likely to play into the hands of that ongoing narrative around the continued strength of the US economy and the likely feeling at the Federal Reserve that they can hold off if need be. Unemployment rate to remain at 3.8. Once again, no real need for the Federal Reserve to grow concerned over this. The U6 measure, which is essentially total unemployment at the bottom there, 7.3% expected. So again, not necessarily expecting to see a rise in that, which would also indicate that we're not necessarily seeing sort of underlying unemployment pressures growing. So both U3 and U6 unemployment expected to remain flat. Average hourly earnings 0.3 expected. So same as last time. Same with the year-on-year metric, 4.1% expected. And we'll get into the nuts and bolts of that as well. And so ultimately, we're not necessarily seeing anything that really should point towards a desperate need for the Federal Reserve to start shifting the direction of travel. Here's an overview of exactly how those numbers set up. So first and foremost, we'll start with the unemployment rate. You can see that we're at a very low level of unemployment, essentially the kind of level seen prior to the pandemic. And whilst we have seen some tentative gains, we've not necessarily seen much by way of significant upside that might push the hand of the Federal Reserves. The non-farm payrolls, top right, we can see that we have been seeing a decline over the course of recent years, but actually an uptick of late, with, again, those 300K and above readings really giving little grounds for concern. Average hourly earnings has been drifting towards the downside. This is going to be possibly the most important part of the report, quite frankly, given concerns over inflation, but has been on a downward trajectory. And the participation rate largely back up to the norm of where we were pre-pandemic following that sharp drop-off that we saw in 2020. So kicking off with unemployment, we can see the unemployment rate is largely flat. It remains below that 4% level. It's at the levels that we saw pre-pandemic. So not necessarily seeing anything too concerning. If we see a rise up through 4%, then maybe it would start to tell a story that's different from what we're seeing at the moment, but that's not necessarily the case. I've also overlaid the conference board's ratio between those that find jobs hard to find and those that find jobs plentiful. We saw a bit of a pullback at the back end of 2023. It's rising once again. That sort of relationship between the two metrics might point towards the unemployment rate ticking upwards, but we haven't seen it thus far, and we haven't necessarily seen a sharp ascendancy in those finding it relatively hard to find a job compared to plentiful in the US. Then in terms of payrolls, and here we can see the strength of those recent figures that we can see more recently above that 300K, but generally between that 200 to 300K. So the speculation that we're going to find ourselves back in the mid 200s doesn't necessarily bring cause for concern. A move back below 200, yes, possibly that might raise some eyebrows. But that's not necessarily what's being speculated at the moment. It's notable that we're seeing that strong uptick in terms of government employment, that yellow box at the top end. So particularly strong employment in the government sector of late, but certainly things still looking relatively strong from this perspective. One underlying sort of metric to follow within this is the breakdown between part-time employment and full-time employment. The problem that we're getting here is the possibility that people are double counting. Essentially, I could take on 2 jobs because I'm getting paid too little for the fact that prices have gone up, and I have to take on a second role. That counts as essentially 2 jobs being created. So you can't necessarily look at those numbers and think that all of those jobs are people taking on full-time jobs. Instead, you're seeing this recent uptick in terms of job growth coming from part-time roles rather than full-time roles. You can see it in actual fact, full-time employment change declining of late. So this is a metric that somewhat undermines the recent gains that we're seeing in terms of payrolls. The payrolls numbers are still strong, but watch out for any continued declines in terms of the full-time employment metric. But like I said, if you're looking at the sort of pre-pandemic zone norm, essentially is between 2 and 300k. Well, we're back above that 300k of late, so not necessarily seeing all too much to worry about at the moment from that perspective. In terms of earnings, we can see here that the average hourly earnings have been tentatively moving lower, 4.14 on the latest metric. You can see it generally tracks that core CPI figure, and this is why it's important, because essentially average hourly earnings or wages are a key determinant of how businesses set prices, because it is an underlying cost that they will have to pay. Well, unless you replace people with computers. But certainly, as things stand, this figure remains overly elevated. And that's part of why we're seeing a very slow decline in terms of that core CPI metric. In terms of the 3-month figure, so this is just showing how things are moving on the short term. So the 3-month annualized, how have wages grown over the last 3 months? And if you projected that out over the course of the year, where would it be? Well, you can see that shaded box sort of shows where we were pre-pandemic. That's where we want to get back to. We've tentatively been above that level. So wages or recent wage growth has been tracking above where we need it to be, but not necessarily heavily so. But I would say, given the impact wages have on inflation, this is going to be an absolutely key part of the report. Notably, this week we have seen the US employment cost index coming out, and it came out with a somewhat concerning 1.2% reading. Now, this is a quarterly release, and so this 1.2 quarterly figure does mark a break from the decline that we've been seeing over the past couple of years. You can see in that orange line the decline in total compensation and the employment cost index. That has broken with that move up to 1.2. Now you can see that we generally have got a pretty decent correlation between the quarterly employment cost index, total compensation, and the quarterly average hourly earnings. So this metric is taking essentially the monthly average hourly earnings figure and then wrapping it up into quarters and moving along. You can see that we do have this close correlation. Does that point towards the possibility that we're going to see a similar uptick in terms of average hourly earnings, and a rise in terms of those wage pressures really could provide concern for markets, given the implications, as we saw previously, on inflation? Talking of inflation, this is not necessarily a chart you're going to see many places, because it's a very different way of looking at inflation. But essentially, what I've been noticing really is that since February onwards, we've been seeing a significant uptick in terms of monthly inflation. So you can see those headline numbers, and they might say, inflation remained flat or moved slightly lower. The key thing is the monthly inflation metric. And what we can see here is that that has ticked significantly higher. If you see a 3-month annualized, which essentially means how did the last 3 months look and how would a year look if we projected that outwards, we have seen a significant uptick of late, in particular in that headline inflation metric, with a sharp gain on that front. So, if you look at a number of different ways, the core metric, when you get rid of the shelter aspect, because a lot of people say that the shelter component is too lagging and therefore it's not fit for purpose. And if you look at more recent data, it would signal a bigger decline in terms of shelter costs. Well, look, whichever way you look at it, we're seeing inflation moving towards the upside over the last few months. And generally, because the last 2 inflation metrics coming out of the US were the sort of significant ones, I wouldn't be surprised to see this move higher once again, once we see the next US CPI moving, latest US CPI release. And then I wanted to sort of bring things home in terms of how these recent developments impact markets. So first and foremost, the resurgence in terms of inflation pressures that we're seeing here provide us with expectations that the Federal Reserve will not cut interest rates anytime soon. It keeps getting pushed back and back and back. So you can see at the turn of the year, as we started 2024, that's pretty much the bottom for where markets were essentially expecting rates. We expect to see 7 rate cuts this year. It was going to be, a year that was going to be massive for equity markets. And instead, we've seen those expectations move towards the upside. Now, those rate expectations also have implications for the US 10-year, and we've seen the US 10-year moving towards the upside as a result. If you look at that top chart and you look at the bottom chart, you can see that by and large, this is what has been driving the sentiment around the US dollar. So those gains have been continuing over the course of this year thus far. So that turnaround in terms of the US dollar is born out the idea that we continue to see those interest rate cuts pushed further back into the future. So the question mark here is, where do we expect rates to be by year end? And that therefore impacts yields, and that therefore impacts the US dollar. So the question we have to ask ourselves within this report is, how would it impact the expectation of the Federal Reserve? Well, what are we expecting? We're expecting to see the payrolls number come down, but we're coming off the back of something like 4 or 5 beats in terms of the payrolls number. So even if it comes in line with expectations, it's still a strong number. So it's not necessarily cause for concern. But if we see another beat, which we have been seeing time and time again, that could provide even more reason for people to feel confident in the US economy. Unemployment remains low. We're not expecting to see a significant surge in unemployment. And then average hourly earnings, we can see that the relationship between that employment cost index and the average hourly earnings does point towards a potential pickup in terms of earnings. So potential inflationary pressures, the US economy looks like it's still going to remain strong in terms of the metrics that could come out on Friday. And so it all points towards a possibility of strong economy, but a resurgence in inflation, which is a continuation of the trend we've been seeing over recent months, which points towards a possibility of further upside for, say, that 10-year yield that we're seeing at the top end as rate expectations get pushed further out. And therefore, that points towards a possibility of US dollar strength. So let's look at exactly how things are playing out on that perspective. I'm going to go full screen so you can get rid of my head and really focus on exactly what's important. So first and foremost, let's look at the real long term. Here's the monthly time frame for the dollar index. What do we see? Well, we're within an uptrend. You can see that the lows down here in 2011 really set us on this trajectory where we see that bull market consolidation. We saw that big bull market taking shape over the course of the pandemic. And we peaked out here in September 2022 as people think that we're moving into a period where we're going to start seeing interest rates cut and alike. The pandemic's behind us, and soon enough inflation will be behind us, and we'll be able to see equity markets boom and the US dollar really coming out of favor. Well, more recently, and remember we were talking about the turn of the year where those expectations around the interest rate cuts, that's where it bottomed out. Well, that's where the US dollar bottomed out, and we're seeing it gain ground since then. So if we see strong data in terms of the US economy, in terms of payrolls and unemployment, both remaining in a good position, and if we start to see those wage pressures build, then you're talking about the possibility of further extensions in terms of that view for when we're going to see interest rate cuts. And that would point towards the possibility of US dollar strength. So what we're looking at here, well, we're looking at a sort of flag formation. You're looking at sort of pennants coming into play here. So continuation patterns, essentially. So you see the rally, the pullback, the rally, the pullback. Well, are we ready for that next move towards the upside? Let's look at how it's shaping up on the near term. I just want to get rid of all of those drawings, remove drawings. So are we exiting this phase? Well, there's a number of different ways that you might look at this, but essentially you can see on the bottom end, we've got sort of trend line support, trend line resistance. Are we breaking through trendline resistance? We can push this further out and possibly say, we're around that at the moment. But more notable is the breakup through this near-term swing high, which comes at 106,188. That break points towards a possible end of this phase and the beginning of another bullish phase for the US dollar. We could still come into a sort of, rally, pull back into support and rally, or we could come into a rally, pull back into here and rally, or even a rally into resistance where we are at the moment, pull back into a retracement and then move onwards and upwards. But ultimately, the trend that has been playing out in terms of the creation of lower highs appears to be over. And that points towards the bulls coming back into place. So whether we see a near-term pullback or whether we don't, we just push onwards and upwards from here. This does look prime for a potential bull run, especially if we do see strong data coming out of the US economy, given the way that the inflation trajectory continues to push back those rate expectations. In terms of the S&P 500, let's see how this is working in terms of the market against the US 10-year, or we could just look at it against the US dollar index, just because we already have an idea of where we think that's going to go. So you can see the relationship. Let's just invert the dollar index. So the relationship that we've been seeing in the past is this inverted relationship, right? So US dollar strength means weakness for equity markets. Of late, that has been a little bit iffy. You saw a little bit of a topsy-turvy time at the beginning of this year as we saw essentially equity markets gaining ground, despite the fact that we saw that bottom essentially for the US dollar as we start to see those expectations from the Federal Reserve reverse, right? But it feels like that US equities have finally cottoned on and finally care about what's happening in terms of expectations for the Federal Reserve. Here's the 4-hour chart, and you can see that shift from not really caring and just moving towards the upside for US equities to more recently, and this essentially is in April, things have started to move in tandem once again. You can see this trajectory. Let's go on the 1-hour time frame, and you can see much more clearly this close inverse correlation between the two. And so it would point towards, if we're looking at a potential exit towards the upside for the US dollar, you're looking at a potential exit towards the downside for the US equity markets. So that would mean that the rally we're seeing at the moment is a retracement before we roll over once again. Well, let's look at the top end of this previous trend before things got a little bit carried away. You can see that we do have this sort of wider retracement coming into play. So is there a possibility we rally into trendline resistance before we roll over? Possibly. Is there a possibility that we're going to respect Fibonacci resistance? Just trying to see exactly where I draw this from. It's not necessarily the clearest, quite frankly. This would actually tally up with the 76.4 alongside that descending trend line. So there is a possibility of a near-term bounce before we see a move lower. Of course, there's still time between when I've recorded this video, which is Tuesday, and when we see the jobs report, which is on Friday. So anything could happen here in the meanwhile. It could see a near-term rally. But look, I struggle to see an example of where we're going to see, or a situation where we're going to see this jobs report really signaling to markets that, yeah, you can expect to see a load of rate cuts coming around the corner. Whereas I can see a situation where we possibly see more concern over what the Federal Reserve are going to do. So yes, near term, we could see some upside, but I think there are inherent risks around this jobs report. And given that potential breakout for the US dollar, ultimately, we're looking at a market that is at risk of rolling over. If you're looking for signals of that happening, you're going to look for a breakdown through your prior swing low. So we've already got that drawn on here. Let's say we do rally, then we'd be looking at this swing low at 50.61. But, I can't tell you that that's going to be the case. So, we're rallying, we're creating high highs and high lows, but from this wider trajectory, it does look like we could be skating on thin ice here. There are inherent risks that we could see the US markets roll over once again. And this jobs report could be the thing to spark that off. So keep an eye out for this jobs report. Of course, if we see average earnings in particular moving towards the downside, or if we see the payrolls numbers coming in particularly weak, and that makes people think that the Fed need to do something, then we could start to see US equities gaining further ground. But I do think there are significant risks inherent within the market at the moment, partially because of this inflation pressure that has been building of late. And given what's happened in terms of that employment cost index that we've seen earlier on in the week, I think there's a good chance that we could see a similar kind of thing coming into fruition soon enough, whether it's this report or a future report, in terms of the average hourly earnings. And that would be a real concern for markets. So average hourly earnings, maybe in the past it has been largely ignored, but it could become front and center of this coming US jobs report taking place on Friday, the 3rd of May.